these companies spent, billions of dollars building out fiber optic cable. And it turned out that, when the dot-com bust happened, not that much of this capacity was being used. So 85% actually, to put a number on it, of fiber optic cables were dark. They were not being utilized. And that, just based on basic economics, sent prices crashing. So the price of internet bandwidth fell 90%. And that's obviously very bad for the telecoms, many of which went bankrupt, like Global Crossing being a big example. And so that's risk number one, which is you're on the hook. You're opening your checkbook to write the check to build out this technology. If it works, that's good. If it doesn't, you're the one who's on the hook.
So it's my birthday, and this year I'm celebrating by giving a special gift away to one of you. And to officially wish a happy my birthday to you, I've packed this tote with a few surprises from our signature Few Crew merch portfolio. And it's not just random merch. Inside, you'll find some items that really quietly signal you know exactly what you're doing in these markets. And the tote, well, it won't hedge your portfolio, but it will make you look smarter than anyone pretending they know what risk on means at the grocery store. If you want it, here's what you need to do. Follow Lead Leg Report on X. Follow Mela_Schaefer on X. Subscribe to Lead Leg Media on YouTube and like and share this video. Only one person gets the tote, but since everyone gets our content, it's really a happy my birthday to all of you. I'm your host, Melanie Schaefer. Welcome to Lead Leg Live. Today, we're talking about the AI trade shifting from build-out to adoption. We've heard the bubble question getting louder, including a recent warning from Microsoft CEO Satya Nadella that for this not to become a bubble, the benefits have to spread beyond just the biggest players writing the CapEx checks. My guest today is Kai Wu, founder and CIO at Sparkline Capital. Kai, it's always great to have you here.
Thanks for having me back, Melanie.
So it was mentioned recently in the Financial Times, actually, that Nadella's view is basically if AI gains don't spread into the real economy, the boom risks turning into a bubble. When you say we're entering the adoption phase, what exactly do you mean by that, and what's coming next?
Yeah, so this nomenclature comes from the work of Everett Rogers, who kind of coined this diffusion model of technology. And you can kind of visualize it as an S curve where technological adoption, starts off with a small group of innovators and then eventually spreads more mainstream before asymptoting and kind of plateauing once the market is saturated. And we've seen this across many historical episodes, ranging from electricity to the internet to cell phones, these kind of S curve shaped adoption cycles. And so you think about AI where we are today, and really a lot of the energy, both at the corporate level, so the CEO of Microsoft, of course, as well as amongst investor focus, has been on the build out, what I call the infrastructure phase of the cycle. And that's all been about, hey, can we actually marshal the resources necessary to put together this, the physical infrastructure to run GPUs and run AI models at scale? Right? And that's been mainly the work of NVIDIA and the hyperscalers, as well as kind of utilities and more kind of hardware companies building out enough capacity. Now, that narrative really kind of took off maybe last year and accelerated into this year, right? With 2026 CapEx expected to be almost double what it was last year. So we have trillions of dollars now being spent over the next few years in kind of planned construction around AI data centers. That's kind of the first phase of the boom that we've seen, again, repeat in historical cycles too. But if you go back to history, what happens next tends to be a little bit different, which is at some point, people say, wait a second, we have the build out secured. Now the question is, will they actually buy it? Right? Will there be enough end user demand such that the initial outlays we're making now will be justified, and returns on investment are adequate amongst the end users, will then justify spending more, and then ultimately that will flow as revenue to the infrastructure builders. And what's quite interesting is you can track the returns of stock prices through the cycle, and it tends to mirror where you are in the cycle. So for example, in the very beginning, it's the infrastructure builders who do the best, of course, as CapEx plans, are kind of revised higher and higher and higher. again, this was the same in the dot-com boom and, has been the case so far today with the infrastructure stocks and AI doing the best. But, if you look historically, there's also been a tipping point. When you shift from phase 1 to phase 2, the adoption phase, what actually happens is it's the adopters of the technology that end up doing better than the builders. And, if you look at the long-term history, that this tends to be kind of the way things play out, where the long-term winners of, infrastructure build-outs and technology booms are not actually the builders for a variety of reasons we can get into, but actually the adopters of the technology, able to use it as a way of gaining market share over their competitors who may be a little bit less tech savvy.
Yeah. And so to tap into that a little bit more in your recent investor letter, which I urge our viewers to sign up for, you cite that in the data that's only about 10% of businesses are using AI in production right now. Why do you think that adoption is still so low? And what do you think changes first as that number starts to rise?
Yeah, look, I mean, let's talk about two things. So first is consumer adoption. Right, people have been very, very impressed at the rate at which OpenAI's ChatGPT application has been able to gain users. This exponential increase, one of the fastest apps to reach, whatever million users. One interesting side point though is that only 5% of those users, approximately, actually are paid subscribers. Right, so 95% of folks, don't necessarily see enough value in actually paying. Right, so and then you go to the enterprise side. So what are businesses actually doing? To your question. Enterprise adoption is always going to be slower than consumer. And it's not even about AI specifically. Enterprise adoption of any technology or any new system is just slow because, for big companies, it takes a long time to move the battleship. And there's a lot of, money and jobs at stake in these cases. So they don't want to kind of rush into things. So even though ChatGPT was released over 3 years ago, we're still seeing, firms take a generally cautious stance towards adoption. So 10%, and it kind of mirrors where I think we are in the cycle. So if you go back to that Everett Rogers model, he defined the kind of early phases being like the tip of the spear is like 2.5%. And then early adopters are around, 12 to 15%. Right. So the 10% number kind of makes sense as roughly mapping to where we would be on the cycle if it were the case that we're now reaching this adoption phase, post build out.
Yes, talking about the cycle, you make a point in the letter about needing proof of ROI, which you just spoke a little bit about, and not just AI activity. When you look across earnings calls, what separates the companies with real AI-driven gains from the ones that are just sort of telling the story?
Yeah, so this is something I've been paying a lot of attention to over the years. These AI adoption metrics are have been kind of something I've been tracking, real times, even before ChatGPT was launched. And one thing that's happened is that as AI has become very overhyped, you've seen a tendency for CEOs to want to just talk about it because, it'll boost their stock price and it's kind of what you're supposed to do. So the trick became, how can we go about, this is obviously useful data, right? There's thousands of companies that are talking about their businesses on these earnings calls. So we want to be able to use it. We also don't want to fall trap to being kind of played by corporate spin. How do we go about disentangling what is, just talking about AI versus actually doing stuff? And so what we decided to do was to look at mentions that included tangible, numerical ROI or efficiency or cost gains. And so what I mean by that is if a CEO says, oh yeah, we're using AI to transform our business, that's very vague. It doesn't mean anything. Of course, everyone's going to say that. But if they say, actually, we used this new AI product called X and it helped increase the asset utilization of our of this thing we have by 12.15% or some kind of numerical amount, it's more likely that they're actually citing tangible gains. So that was kind of the way we went about doing this. And of course, we use a large language model itself to go through all the earnings call transcripts and classify them as being into one of three buckets. The broadest bucket is just any mention of a company using AI, even qualitatively. The middle bucket is mentions of companies using AI, where they can link it to a specific reduction in cost, expansion of revenue, or some sort of tangible metric with a number attached to it. And then the final bit was actual ROI, return on investment, which means that not only can you show the gains, but you can show the gains relative to the costs. Because again, even if you have a, tremendously useful AI product, but the product itself costs $1 billion to buy, that's not that useful. So those are kind of the three categories that we use to parse all these earnings calls.
Yeah. So when you're collecting all that data, and this, question is probably for investors who are listening from the outside, what are some of the cleanest examples of AI showing up in fundamentals in terms of revenue lift or productivity, cost savings, as you mentioned?
There are hundreds of interesting examples, and I did include one exhibit, which we should put up, where I highlighted a few cases. So like, for example, Target talked about how they were using, kind of AI within the warehouses to help improve the efficiency of picking, goods. There were examples around, managing inventory around lots of different SKUs, a biotech use case around R&D, employee management systems. So I think there was a storage company that was using a system to help manage their workforce. So their kind of labor costs were being reduced, and retention was increased. Examples of the classical example, of course, is Meta using it to improve their ad conversion rates, so for digital marketing. But yeah, there's a ton of different applications, and I think the key thing to focus on is the fact that it's not just Meta, right? It's not just tech companies. It actually is starting to seep, as Nadella, hopes, with this diffusion concept, into the real economy, into businesses outside of just technology.
Yeah, so I want to pivot a little bit, just talk about your framework, which tries to avoid being overexposed to the most crowded, as I talked about the first question, CapEx heavy part of the AI trade. In plain English, what's the risk investors take on, Kai, when their exposure is basically concentrated in the infrastructure layer?
So I think there are two main risks. The first is the fact that these companies are spending tens, if not hundreds of billions of dollars on building out these big data centers. And this is money that they expect to earn back over the next, say, 5+ years. But the problem, of course, is that's a speculative bet. If you go back to the history of these buildouts, let's talk about the dot-com boom. In the dot-com boom, telecoms were the utilities that built out the backbone of the internet. These companies spent billions of dollars building out fiber optic cable, and it turned out that when the dot-com bust happened, not that much of this capacity was being used. So 85%, actually, to put a number on it, of fiber optic cables were dark. They were not being utilized. And that, just based on basic economics, sent prices crashing. So the price of internet bandwidth fell 90%. And that's obviously very bad for the telecoms, many of which went bankrupt, like Global Crossing being a big example. Right, so that's risk number one, which is you're on the hook. You're opening your checkbook to write the check to build out this technology. If it works, that's good. If it doesn't, you're the one who's on the hook. The second risk is just valuation risk. One thing I looked at was the extent to which there's a group of companies, which I call AI infrastructure stocks, which are mainly the Magnificent Sevens, so NVIDIA and the hyperscalers, as well as a few other folks like Oracle makes it in, and CoreWeave, companies like that. These companies, their valuations went from, say, 10 years ago, a small premium to the market, to now almost 2x the market, right? And what I'm saying is, oftentimes we discovered this in the dot-com boom as well, which is the internet became a thing. The technology was successful. The problem is that investors, who came in at the wrong time made no money. In fact, they lost money because valuations matter. Because if you buy any investment at too high a price, is not a good investment. And that's kind of what's happening here, potentially, with these stocks running up so highly that anyone who wants AI exposure knows where to go. It's just too obvious to trade. And so because of these elevated multiples, they're really priced for an outcome that, if it works out, it is good. But there's a lot of downside and a lot of risk in the event that there's an air pocket, or there's a mismatch in when the revenue ultimately comes, if it even does, relative to the amount of money they're spending right now in trying to build for this future potential demand.
Yeah. So where specifically then is the market mispricing AI adoption?
Yeah. So I think the opportunity is actually not in the infrastructure firms. And we've been rotating out of those companies over time into a group that I call early adopters. And so when I say early adopters, what I mean is, so non-infrastructure companies, you can kind of take that, 80 to 90% of the universe and segment it into firms that are investing in AI and those who are not, which I call the laggards. My thesis here is that, as AI becomes more and more powerful. And if it indeed will be transformative, which I think many people, including myself, expect it to be, and including Satya Nadella, who expects it to, he says, bend the productivity curve to really increase margins for the companies that are using it. Then the opportunity is more in looking at this massive dispersion across names, where you find in any given industry a handful of early adopters that are really aggressively pursuing the opportunity. And then the majority of companies are laggards. They're just doing nothing. They're kind of playing wait and see, or whatever. And we're seeing this with stock prices the past week or even the past year, with software stocks going down. A couple of days ago, it was wealth management stocks going down at, these kind of disruption fears that are roiling the markets. The market's finally catching up to this idea that AI is actually here to stay and it will change the world. And I don't think they're doing it correctly, but they are recognizing that there will be separation between winners and losers due to AI. Now, the really interesting thing is, to my point about indiscriminate selling, that if you look at the valuations of the laggard basket relative to the early adopter basket, they're basically the same. So as I mentioned, go back 10 years, infrastructure stocks valuations have increased a lot. The other two groups, early adopters and laggards, have basically stayed steady relative to the market. And there's really very little difference between the two, implying that the market is basically saying, I think either everything will be disrupted or nothing will be disrupted, but is not, being thoughtful about how there's some dispersion, that maybe some companies will be winners and others losers, and not really rewarding companies for the investments they're making in AI, even though we expect those to translate into tangible gains as we move forward.
Yeah. So then for an advisor who's thinking about how to fit things into their portfolio, or if someone wants AI exposure but doesn't want to be all in on the most expensive, most crowded names, as you've mentioned, what does a reasonable allocation mindset look like?
Yeah. So first of all, I think just to kind of level set, I think the challenge that we face today, advisors face today, and anyone, even retail investors, is that the standard indices, let's take the S&P 500, they're just massively overloaded with AI infrastructure stocks. So for example, the S&P 500 is 33% Magnificent Seven, which we all know. But then if you add in the Oracles of the world, the rest of the infrastructure stocks, you're talking about almost 50% of the index. So you think you're making a passive market bet on the market, but really you're just taking a huge, a huge exposure, a concentrated exposure to the sustainability of this boom and the trillions of dollars being spent, in building out these data centers. And if it works out, that's fine again. But if it doesn't, you actually have a lot on the line. And I think people don't, correctly appreciate the extent to which they are making that implicit bet. So what are the solutions? I think there's two things people have generally done. One is they said, you know what, I'm so scared of this AI bubble that I'm just going to completely go the other way, buy, value stocks, buy international stocks, buy, small caps that have less exposure to AI. And you can do that. The problem is that then you're basically taking the opposite risk, which is that what if AI does continue to advance and the technology does improve? Well, then you're missing out on the entire thing, right? That's like someone who owns no internet stocks in the dot-com boom. Okay, fine, you missed the bust, but you also miss out on this revolutionary technology. And so you just get chock full of laggards if you do that. I think that the solution is, kind of framing this not so much as a dilemma, but there's kind of this middle ground, this third option, is how I've talked about it, which is these early adopter stocks that, offer a lot of the upside of AI if it works out. These are the kind of second order beneficiaries of AI technology, right? The examples would be, retailers in the railroad boom of the 1860s that were able to use the technology to ship their goods more efficiently, or Netflix, Meta, Google in the internet era. They were the big long-term winners because they were able to use the internet, the subsidized internet, because of the price of bandwidth falling so much, to build these huge businesses, right? So the early adopters, have historically been the kind of winners in the end game. And where the infrastructure builders end up being utilities. I'm not saying it will necessarily play out that way. But you keep that in mind when, when you think about where should I be putting my money when I'm betting on AI, and then pair that with two more pieces of information. One is that the early adopters are a lot less overvalued, as I mentioned. Two, they're a lot less capital intensive. In fact, they're actually more capital light now than they were 10 years ago because they're offloading a lot of the infrastructure building costs to the cloud providers. And I guess third, this third point would, in their favor is just diversification, right? Like the infrastructure firms are like 85% technology companies, whereas the early adopters, they have some tech bias. Obviously, tech companies tend to be more, progressive when it comes to adopting technology. But the majority of the early adopter basket is actually industrials, healthcare, financials, kind of these old economy companies. And it just happens to be the leaders in each category, in each respective sector, that, from a relative standpoint, are believed to have a potential advantage due to their, forward-thinking investments in AI. So I think that the early adopters, are, really an underappreciated, but potentially clever way to play the AI boom, where you can get a lot of the upside, where you can, while also mitigating some of the risks of a potential bubble.
Yes, okay. And I mean, a lot of the information that we've discussed here is in your investor letter. Where else can people go to find out more about you? Where can they sign up for the investor letter, and where can they go to be in contact with you?
Yeah, so the investor letter is obviously about the funds themselves. So it lives on our fund website. So it's just etf.sparklinecapital.com. And you just go to the website, you'll see this year's letter, last year's letter as well. And if you want to just find me more in general, like I have a website where I just post kind of more the more academic research I do, called sparklinecapital.com. And I'm also available on Twitter and LinkedIn at @CKaiWu.
Awesome. Well, Kai, thank you again so much for joining me, and thanks to everybody for watching. Be sure to like, share, and subscribe for more episodes of Lead Like Live.